Not a long time ago, we decided to work on a free, let's say, toolkit that is able to provide a rough estimate of the tax bill in Italy, and we released the first version just for you. And by the way, the software is, 100% free of charge, so you can ask a copy at studiorigo@gmail.com. The very first people using that estimator got caught by surprise when they found out how taxes in Italy really work. Not in terms of, percentages, the 23, 43%, incremental brackets, and so on, but in terms of understanding how many different types of taxes we have here. Investments in particular. More likely, when you decide to save some money and invest some money, your scope is to get some returns, such as dividends, if we are talking about bonds, for example, interest from bank accounts, or rental income, if you're into leasing and buying properties. Either way, the trade-off is easy to understand. Your expectations are met when this money invested is able to generate passive income over the years. When you move to Italy, almost everything that can generate such a stream of income will be considered taxable. Twice as much. Listen carefully. On one hand, investments and properties such as brokerage accounts will be included in the RW framework of your Italian tax return named Modello Redditi. According to the current rules, 0.2% to 0.4% is the tax rate for that, based on the balance to be paid every year. Simply because you own that account, it's called wealth tax. Just a few people know that complementary retirement accounts could suffer potentially from the same rate, even if your home country may consider those funds tax-free for whatever local rules. And when you decide to start cashing out your money out of your retirement accounts, those streams will suffer the capital gain tax or the incremental 23 to 43% tax. Let's assume you also have some money sitting in some pure investment account, those that will give you dividends on a regular basis. In this case, on top of the 0.2% to be paid per year on the balance, you have to manage the 26% flat on the money earned. On the net basis, just to be clear, so you can deduct all the losses against the gains. Same logic for interest paid by bank accounts that give you, some premium treatment as long as you leave the money sleeping on the saving or checking account. And just for the records, bank accounts suffer the wealth tax too, not on a percentage basis, this time with a fixed amount of 34 euros per year for each bank account with a balance more than 5,000 euros. So the takeout here is to understand when it's good to find a good tax regime for your personal income, when it's time for you to look for a better deal in terms of investment tax, and when it's better to avoid a tax regime that facilitates businesses only. This is why a lot of people get conflicting information and feedback regarding the regime forfettario, for example, the 5% for business owners making less than 85,000 per year, and regarding mainly the 7% for pensioners in the South. There is no one-fits-all tax strategy and fiscal blueprint that works for everyone, regardless of the money invested or source of your income. Please put everything on the table, always. Everything listed on your name in terms of income, asset, properties, and everything you're the beneficiary of, such as trust and bank accounts. Yes, I said trusts. The wealth tax is for them too.